information by answering the first question. We had chosen 3 different stocks from 3 different companies. This is the trend analysis and chart pattern of Apple Incorporation, Netflix Incorporation, and Intel Corporations for December 2020 to January 2021. Now, I will explain further about the analysis for stock 1. Based on figure 1 above, Apple Incorporation stock price had fluctuated during the month of December 2020. Started from 5th January 2021, the stock price going through ups and downs until 18th January. Despite the fact that there was a drastic increase on 19th January, but after that, the stock price declined erratically and then stabilized. Upon the situation, it clearly shows that the Apple Incorporation had been affected by the January effect. Hence, the investor can obtain an abnormal return if they buy the stock on 15 January and sell on 26 January, since the stock price shows a rapid increase in a short period of time. If the investors are planning to invest in a long-term investment, they could also gain profit as the average expected return for the stock price is 0.33%. This is the appendices to calculate the daily stock return for December 2020 and January 2021.
On 4th January 2021, the pattern of stock for Netflix Incorporation changed from day to day until 19 January 2021. On the other hand, there is a drastically rising of the stock price on 20 January 2021. Hence, Netflix Incorporation was affected by the January effect. As a result, investors can gain abnormal return if they purchase the stock on 12 January and sell it on 20 January. Investors also may obtain a profit in a long-term investment since the average expected return for the stock price is 0.18%. This is the appendices for Netflix Incorporation. The expected return for Netflix Incorporation is 7.385%.
Based on figure 3 above, Intel Corporation stock price fluctuated during the month of December 20. Started from 5th January 21, the stock price going through ups and downs until 20th January 21. Despite the fact that there are a drastic increase on 21st January 21, but after that the stock price declined abruptly and increase stabilized. Upon the situation, it clearly shows that the Intel Corporation had been affected by the January effect. Hence, the investor can obtain an abnormal return if they buy the stock on 4th January and sell on 21st January, since the stock price shows a rapid increase in short period of time which was affected by the January effect. In addition, in a long-term investment, they could also gain profit as the average expected return for the stock price from December 20 to January 21 is 0.003%. This is the appendix to calculate the daily stock return for December 2020 and also January 2021.
Diversification is a risk reduction strategy that allocates investment across various financial instruments, industries, and other categories. It has objective in maximizing returns by making investments in various areas that will react differently. Diversification is the most crucial component to reach long-range financial goals while minimizing risk. Our trading plan is we intend to invest RM1 million in a wide-ranging portfolio that is made up of non-correlated asset types. Therefore, we decide to invest in exchange-traded funds ETFs. Similar to regular stock, they can be purchased or sold on a stock exchange. An ETF can track anything from a single commodity's price to a large and diversified group of securities. ETFs consist of stocks, commodities, bonds, or a mixture of investment types. In addition, ETFs are a low-risk investment as they are more cost-effective and liquid than mutual funds. This may be advantageous to us in terms of building wealth and profit over a long period of investment.
In the case of risk management is needed in trading and investing to help keep losses under control and keep a good risk ratio. Therefore, there are 2 methods that can be used. Firstly, we can apply the stop loss and take profit point strategy. Stop loss is where the limit of our trading is set based on how much risk we are willing to take. Meanwhile, take profit is where the limit order is based either above or below trade price according on how much profit we want to gain before closing trades. Secondly, we can consider the 1% rule. Risking all 1 million in single trade will increase the risk. Hence, we should put not more than 1% of our capital. Taking small risks will not blow our account up with 1 or 2 losing trades, and probability of surviving is high.